Chasing past returns. The amateur stares at the green bar, last year's 50% return. The thought creeps in, I'll just jump in for a week. That thought, that exact moment, is where you lose. Last year, the market handed out a 25.02% gain. Investors actively threw 8.48% of it in the trash. Dalbar's research confirms this is the second largest behavior gap in a decade. Not fees, not bad funds, pure behavior. Morningstar tracked investors over 10 years. The funds returned 8.2% annually. The actual investors, 7.0%. That 1.2% gap doesn't sound massive until you realize it equals 15% of total returns evaporated into thin air. Here's the brutal pattern. The VanEck Semiconductor ETF turned $10,000 into $180,000 over 10 years, but only for those who held through the 30% tech crashes. The ones who chased it after the gains? Crushed. Smart investors ignore last year's chart. They ask, does this strategy fit my actual timeline and goals? Overlapping ETFs. You bought 3 ETFs. You think you're spreading risk. You're actually paying triple fees for the same 7 companies. SPY and Triple Q, 2 different funds. 84 overlapping holdings. 8 companies making up 28% of SPY and 44% of Triple Q. You didn't diversify. You just bought Microsoft and Apple on repeat. Most beginners see 3 tickers and assume safety. The pros run the overlap analyzer first. Here's the nightmare scenario. You own VTI thinking it's your broad market foundation. Then you add Triple Q for tech exposure. Except VTI already contains 93% of Triple Q's holdings by weight. You just paid management fees twice for 0 additional protection. The real danger isn't the wasted fees. It's what happens when Nvidia reports bad earnings. Your diversified portfolio doesn't just dip, it craters. You're 20% concentrated in a single sector without knowing it. You think you're diversified, but you've actually built a house of cards. Experienced investors keep total overlap under 30%. Beginners discover their concentration during the crash. Believing ETF Names. 2. Healthcare ETFs. Both sound safe, but they are completely different in how they actually behave inside your portfolio. XLV holds 65 companies, which sounds diversified, but the top 10 holdings control around 58% of the fund. So even though XLV is a legitimate healthcare ETF, it is heavily concentrated, meaning just 10 companies are driving most of its performance and most of its risk. VHT also focuses on healthcare, but holds around 400 companies across large, mid, and small caps. Its top 10? Just 49% of the fund. Same sector, same industry, but a completely different risk profile. Most people read the fund name and move on. Smart money reads the fact sheet. When one of XLV's top concentrated holdings misses earnings by 2%, the entire fund can drop 8% in a single day, because those 10 companies carry so much weight. Concentration works both ways. Explosive gains when those top stocks perform, devastating losses when they stumble. Before you click buy on any ETF, check 3 numbers: total holdings, sector concentration, and top 10 percentage. If top holdings exceed 50%, you are not truly diversified. You are betting that those 10 companies all perform well at the same time. Market timing. 10 days. Miss just 10 days out of 5,000 trading days, and you lose $3 million. Allworth Financial ran the numbers on a $1 million portfolio over 20 years. Stay fully invested, you end with roughly $4 million. Miss the 10 best days, you end with $1 million. $3 million. Gone. Because you tried to be clever. Here's the cruel part. Those best days hide right after the worst days. March 2020. COVID crashes the market 30%. You panic. You think, I'll get back in when things stabilize. The market rebounds in months. You're still waiting for your perfect entry. You missed it. Completely. 2008 plays the same game. Market crashes 50%. Investors bail thinking this time is different. Then they watch the longest bull market in history launch without them. They never get back in at a good price because certainty never arrives. Trying to time the market destroys returns. Setting a consistent investment schedule and executing regardless of headlines builds wealth. Dollar cost averaging isn't sexy, but it means you're buying at discount prices when everyone else is panic selling. That's how actual wealth compounds. Ignoring fees. 0.5% sounds harmless. It's not. Invest $100,000 in a fund generating 4% returns over 20 years. With a 0.5% expense ratio, you lose $20,000. $20,000 vanishes because you didn't read the fine print. Passive index ETFs charge 0.03% to 0.30%. Actively managed ETFs charge 0.59% to 0.89%, 6 times higher. Morningstar's data shows the average passive fund at 0.11% versus active at 0.59%. Over decades, that gap compounds into hundreds of thousands in lost wealth. Then tracking error joins the party. Your low-cost S&P 500 ETF lags the actual S&P 500 due to rebalancing delays and liquidity issues. You think you're getting 10% returns, you're actually getting 9.7% every single year. Add brokerage commissions. Add bid-ask spreads on illiquid ETFs. The costs multiply silently. Beginners look at past returns. Experienced investors check expense ratio and tracking error history. False sense of safety. ETFs are safe, diversified, stable. That's the story everyone tells. Here's the truth. In 2008, the S&P 500 lost 50%. Those safe, diversified broad market ETFs, down 50% with it. But that was a once-in-a-lifetime event, right? 2022, down 18%. 2020, down 30% in weeks. Most people confuse diversification with safety. What diversification actually means, your losses are spread evenly. When the market crashes, your diversified ETF crashes too. It just does it politely. And that's when the real damage begins, when unprepared investors see red and sell at the bottom. They lock in permanent losses trying to stop the bleeding. Pattern repeats. After 20% drops, stocks historically gain 19.9% the following year. The investors who panic sold, they missed the entire recovery, sitting in cash too terrified to get back in. The S&P 500 returned 25% in 2024 after dropping 18% in 2022. If you need your money in 1 to 2 years, ETFs are the wrong vehicle. They belong in multi-year portfolios where you can endure the storms. Want true safety? Choose bonds, high-yield savings, or money markets. But you sacrifice returns for that safety. Accepting volatility is the price of long-term gains. Copying portfolios. Check out my 3-fund portfolio. You see it everywhere. YouTube gurus, Reddit threads, TikTok financial bros. Here's what they don't tell you. Their perfect portfolio could destroy yours. Example. Heavy REIT allocation for dividend income and real estate exposure. Sounds smart unless you already own 2 rental properties making up 50% of your net worth. Follow that advice and you've created a real estate concentration bomb. When the sector corrects, your entire net worth collapses. Or the classic buy QQQ and VGT for tech exposure. 2 funds must be diversified, except they overlap massively. You're duplicating holdings at double the fees. Person giving that advice has 0 tech exposure otherwise. You're already 40% tech. Same advice, opposite outcome, catastrophic results. The person recommending that portfolio doesn't know your timeline, risk tolerance, existing assets, or goals. They're sharing what works for them. When it blows up in your hands, they won't be there to help. Copying without questioning is dangerous. Ask 3 questions before buying anything. What does this actually hold? How does it fit what I already own? Does it align with my specific goals and timeline? If you can't answer all 3 clearly, you're not investing. You're gambling with someone else's strategy. Holding leveraged ETFs. This is where it gets mathematically brutal. This is where the illusion shatters completely. Get 2x the daily returns. The promise sounds like free money. It's a mathematical death trap. Let me show you the exact moment the trap snaps shut. Day 1, stock starts at $100, jumps 10% to $110. Your 2x leveraged ETF soars 20% from $100 to $120. You're euphoric. This is working. Day 2, stock drops 9.09% back to $100. Perfectly flat. Break even, right? Your 2x ETF falls 18.18% from $120 to $98.18. Wait, the underlying stock is unchanged. 0 movement over 2 days. But you just lost 1.82% of your investment. That's not a bug. That's not a mistake. That's the mathematical certainty of daily resets and volatility decay. Now scale that to a choppy month. The stock ends exactly where it started. 0 gain over 30 days. Your leveraged ETF? Down 15%, sometimes 20% or more. You correctly predicted the market would go nowhere. You still got destroyed. Individual stocks are more volatile than indexes. Higher volatility accelerates the decay. The math doesn't care about your predictions. The math doesn't care about your strategy. The math always wins. Chasing 2x returns without understanding daily resets is financial suicide. Experienced investors see 2x daily reset and walk away. Ignoring liquidity. SPY trades millions of shares daily. Costs are razor thin. Then there are the exotic ETFs tracking obscure markets that look exciting on paper but bleed you dry in execution. You want 1,000 shares of a niche emerging markets ETF. Daily volume, 50,000 shares. Congratulations, you're now 2% of the day's trading. Your buy order pushes the price up against you. Your sell order pushes it down. Market impact is a hidden tax no expense ratio captures. Use a market order on a thinly traded ECF with a wide bid-ask spread, and you pay 2-3% more than the last quoted price instantly. That's not a fee. That's the cost of impatience in an illiquid market. These ETFs also have brutal tracking errors because the underlying assets are hard to trade. Management fees run higher because the fund works overtime maintaining positions. You pay more to get worse performance. Chasing niche plays for excitement is expensive. Check average daily volume and bid-ask spread before buying anything. If volume is thin or spreads are wide, either use limit orders or walk away entirely.